Building upon the foundation laid in my previous video, Crash and Burn: How the U.S. Stock Market Fueled the Great Depression 1929, this new installment takes a more detailed look at the specific reasons behind the market crash. Understanding the why behind the crash is pivotal, as it not only illuminates the historical incident but equips viewers with insights to navigate potential pitfalls in the future. This deeper exploration aims to empower individuals with knowledge, fostering a heightened awareness to prevent the repetition of such catastrophic mistakes. In dedicating this video to the memory of those who endured the hardships of the Great Depression, 1929-1939, it serves as a tribute to their resilience and a platform for shared experiences. If any of your ancestors weathered the storm of this economic upheaval, I encourage you to share their stories in the comments. By fostering a sense of collective understanding and remembrance, we contribute to the preservation of historical narratives and create a space for meaningful conversations that transcend generations. Together, let us delve into the why behind the crash, ensuring that the lessons learned from history become a beacon guiding us towards a more informed and vigilant future. 1. Speculative excess. Leading up to Black Tuesday in 1929, there was an atmosphere of speculative excess in the stock market. Investors were gripped by a fervor of optimism, driven by the belief that stock prices would perpetually rise. This unwarranted confidence led to a surge in stock trading as individuals and institutions alike sought to capitalize on what appeared to be an ever-expanding market. The speculative bubble was characterized by an inflated sense of the value of stocks, detached from the economic realities of the time. As the speculative bubble grew, so did the risks associated with investing. Many individuals, enticed by the prospect of quick and substantial profits, entered the market with little regard for the underlying fundamentals of the companies they were investing in. This speculative euphoria set the stage for a precarious market environment, setting the scene for the dramatic events that unfolded on Black Tuesday. 2. Overleveraging. The practice of overleveraging or borrowing money to invest in the stock market was rampant in the lead-up to Black Tuesday. Investors, confident in the seemingly unstoppable rise of stock prices, borrowed significant sums to amplify their investment positions. While leveraging can magnify gains in a rising market, it also increases the potential for devastating losses when the market turns. As the market started to show signs of weakness, investors faced margin calls from brokers. A margin call is a demand for additional funds or collateral when the value of the investor's holdings falls below a certain level. The combination of declining stock prices and margin calls forced many investors to sell their holdings, intensifying the downward pressure on the market and contributing to the severity of the crash. 3. Stock price manipulation. Leading up to Black Tuesday, there were instances of market manipulation that further exacerbated the crisis. Insiders and unscrupulous operators engaged in practices designed to artificially inflate stock prices. These manipulative efforts created a false sense of security among investors, luring them into the market under the illusion that prices would continue to rise. When the reality of economic conditions became evident, investors rapidly lost confidence. The sudden realization that stock prices were artificially inflated prompted a mass sell-off as investors rushed to exit the market before the bubble burst. This wave of panic selling significantly accelerated the decline in stock prices. 4. Economic weakness. The United States was grappling with underlying economic weaknesses even before the stock market crash. Industrial production had started to decline, unemployment was on the rise, and agricultural sectors were facing significant challenges. These economic indicators signaled a broader economic downturn, setting the stage for the vulnerability of the financial system. The weakening economic conditions contributed to a loss of investor confidence. As businesses faced difficulties and unemployment rates soared, the overall health of the economy deteriorated, eroding the foundation upon which the inflated stock market prices stood. The economic weaknesses provided fertile ground for the panic that ensued on Black Tuesday. 5. Chain reaction. Black Tuesday was not just a single, isolated event. It set off a chain reaction of selling that reverberated throughout the stock market. The initial panic selling triggered by margin calls and the realization of overvalued stocks led to a cascading effect. As prices plummeted, more investors faced margin calls or chose to liquidate their holdings to minimize losses. This chain reaction was not confined to a specific sector or group of investors. It spread rapidly, engulfing the entire stock market. The interconnectedness of financial markets meant that the impact of the initial sell-off expanded exponentially, creating a self-reinforcing cycle of panic selling. The chain reaction that ensued on Black Tuesday was a pivotal moment, marking the beginning of a severe economic downturn that would define the next decade. The epicenter of this financial earthquake was the New York Stock Exchange on Wall Street, specifically in New York City. The NYSE was and continues to be a symbol of global financial markets. The panic and chaos that unfolded on Black Tuesday marked the beginning of a severe economic downturn, sending shockwaves through the financial system and laying the groundwork for the Great Depression. Thank you for joining us on this exploration of the Great Depression. The echoes of this historic period continue to resonate, shaping our understanding of economic resilience and the societal impacts of financial crises. If you found this content informative, don't forget to like, share, and subscribe for more historical insights.